Hi friends, welcome to Rec TV. Already we have completed dissolution of partnership form in recent class. Today we are going to discuss about employee stock option scheme. To understand this, let us consider one example. Here, X Limited. X Limited is a newly formed company. Over a period of 20 years, it got a good reputation and very high profits when compared to other companies in the market. So, by looking this, a John, a foreign person, came to India and he thought that he want to start a same company as X Limited to earn profits. So, he started a company that is Y Limited. As it is a newly formed company today, it want a good skilled workers. So, now Y Limited want to take the employees of X Limited by offering good packages to the employees in X Limited. So here X Limited offered equity shares to their employees in order to avoid this conflict. So here now employees also became a shareholders in the X Limited. So they think here X Limited is the company of their own. So employees never want to leave a X Limited and to join another companies who are offering a good opportunities. So this is the reason that employee stock option scheme came into the light. Now how these workouts, let us see. So we have seen the concept of ESOPs. Now how it will work out, let us see. Here grant date. This is a date on which the ESOPs are issued, that is announced to the employees, and there is a vesting period. This is the lock-in period of the shares for which are issued to the employees. There is a 3 years, and with the vesting period there is also some two conditions to satisfy. These are the conditions for satisfy the employees to order the ESOPs. Those conditions are, one is service condition and performance condition. Here service condition means these shares the employees can't touch or can't sell or can't own for a period of 3 years, because they should be in service for a period of 3 years. And the another condition is performance condition. Here the performance condition means the employee should work hard for the performance of company. That means there should be an increase in sales, or there should be an increase in profits, or there should be an increase in the reputation. So this is the performance conditions. If the employees, those who satisfies these conditions, they are eligible for the ESOP scheme. So after completing 3 years, the employees who satisfy the vesting conditions, employee are eligible to got the scheme, that is to opt the scheme. And after 3 years there is a period, that is exercise period. This will be available in question only, that is exercise period to opt the, that is to own the shares which are issued by the company to the employees. Then how it is benefit to the employees? Here look at this. Face value of the share on the grant date is 10 rupees and the issue price is 80 rupees. That it means the issue price means that the shares can purchase by the employee after 3 years at 80 rupees, and the present market value of shares is 200. So here the employee can be benefit after 3 years at a rupees of 120. Here the market value of share is, we can't determine after 3 years. So we are looking at the point of view of grant date. From this example we can say that ESOPs is a scheme where the employee of the company are given a right to buy the shares of a company in future at a predetermined price. And here look at the grant date. The grant date is a date on which the scheme of ESOPs is announced by the company. After the scheme is announced, the employee are expected to satisfy some conditions in order to become eligible for subscribing shares under ESOPs. Those conditions are called as vesting conditions, and the period over which conditions are to be called a vesting period. And vesting conditions can be either service conditions or performance conditions. Once all the vesting conditions are specified, employee become eligible. Once options are vested, the employees can exercise their rights to buy the shares within a specified period, which is referred as a exercise period. So here we saying that this is by this there is a benefit to the employees. To value that benefit, there is two methods, that is intrinsic value of option and fair value of option. Here the benefit given to the employees will be in the form of allotment of shares at a predetermined price which is lower than the prevailing market price. So to value that benefit, we have two methods, that is intrinsic value of option and the fair value of option. So in intrinsic value of option, how you will determine the intrinsic value, that is current market price on grant date minus exercise price. And when we come to the fair value of option, it is determined by using technical and scientific method. Here fair value will be given in the question, so you need not to find for a fair value. Now let us consider one example for ESOPs, that is VBK Limited issued 1000 shares. Face value is 10 rupees, market price is 100 rupees and exercise price is 40. Here exercise price means the employee is going to take these shares at 40 rupees. Now intrinsic value is 100 minus 40, that is market price minus exercise price is equal to 60. Here total value of option is 60 into 1000 rupees, that is 60,000, and the vesting period is 3 years. So from this question now we are going to do solution, that is annual amortization is 60,000 divided by 3, so 20,000 per annum. Now on the grant date, now we are going to pass entry is deferred employee compensation account data to ESOPs outstanding account. So whatever amount you should take means 60,000 and 60,000, because the total value of option that is exercised is 60,000. Now when you are going to see balance sheet shows that is ESOPs outstanding account on the liability side 60,000 and the deferred employee compensation is 60,000 on the asset side. Now this 60,000 is going to return off to the P&L account at the rate of 20,000 per annum. So at the end of the first year, the entry is going to be employee compensation account data to deferred employee compensation account. The amount is 20,000 and 20,000. So after completing this transaction, at the year end, that is the first year end, the balance sheet is ESOPs outstanding account shows 60,000 and the asset side deferred employee compensation account shows 40,000, that is 60,000 minus 20,000. So this year you return off 20,000 to the P&L account. So that's why that's the reason the deferred employee compensation account shows 40,000. And at the end of the second year, here also you should return off one more 20,000 in the second year, that is employee compensation account data to deferred employee compensation account. So after this transaction, at the end of the year, the balance sheet shows ESOPs outstanding account 60,000 on the liability side and deferred employee compensation account shows 20,000, because 40,000 minus 20,000 shows 20,000. And at the year end, that is when we are going to the third year, the entry again will be same, that is employee compensation account data to deferred employee compensation account. So here also it shows at the balance sheet date, liability side ESOPs outstanding account shows 60,000 and the deferred employee compensation account shows nil, because in these 3 years we have totally written off that employee compensation amount, that is 60,000. So the last entry will be to tally our balance sheet, the entry will be bank account data, ESOPs outstanding account data to equity share capital account to securities premium account. So the amount is here, whatever amount you are paying, so it is goes to bank account, that is 1000 into 40. So the employees were paying 40%, therefore 40,000. And the ESOPs outstanding account shows 60,000. So ESOPs outstanding account we are debited, and the equity share capital account shows 1000 into face value, that is 10. And the last securities premium account. Here market price is 100 and the face value is 10. So 1000 into 90. With this we tally our balance sheet. Now we are going to look at one question which is based on ESOPs under SEBI guidelines. VBK Software Limited granted 2000 options on 1st April 2007 at rupees 50 when the market price was 150 and the vesting period is given 2 years. So you are required to calculate the value of options and calculate the amount to be amortized every year and pass necessary general entries for the year 2007, 8 and 2008 to 9. Here now let us discuss the solution part, that is answer part. Here the value of options. So value of option, number of options is given in this question is 2000 and the market price is 150 and exercise price is 50. So we are deducting from market price, that is 150 minus 50. So 2000 options into 100 is equal to 2 lakhs. So the value of options is 2 lakhs. And the second question is calculate the amount to be amortized every year. So we should calculate the amortizing part every year. Here the annual amortization is 2 lakhs divided by 2 years. So 1 lakh per annum. And we need to pass necessary general entries for year 2007 to 8 and 2008 to 9. So on the grant date, what is the entry means? Deferred employee compensation account data to ESOPs outstanding account. Here the amount will be the value of options, that is 2 lakhs and 2 lakhs. And when we comes to the on 31st March 2008 and 31st March 2009, we are going to prepare 2 years in one entry, that is particulars year 1 and year 2. And here the first entry is employee compensation account data to deferred employee compensation account, 1 lakh in the first year, and in the second year also it is 1 lakh. It is because we are transferring the deferred employee compensation account for 2 years to the P&L account. So year 1 lakh is transferred to the P&L account and year 2 also transferred to the P&L account. So the entry will be P&L account data to employee compensation account, 1 lakh and 1 lakh. And last, that is here we have made an assumption, because in the question it is not given how many employees are, how many options were opted by the employees. So assuming that all 2000 options exercised on 13th June 2010. So the entry will be, this is the final entry, bank account data. So whatever amount you are receiving, you should be debited to the bank account, that is 2000 into you are receiving 50 rupees from employees, that is 2000 into 50, 1 lakh. And ESOPs outstanding account we are debiting with 2 lakhs, that is the value of options. And to equity share capital. So it is equity share capital is taken on the face value. So equity share capital is equal to 20,000. So 2,000 into 10, 20,000. And the last, that is securities premium. Here securities premium will be that 2000 into 150 minus 10. Here the value of market price is 150 and the face value is 10 rupees. So while you are deducting 150 minus 10, it is goes to the securities premium account. So 140 into 2000, 2,80,000. This is the entry for. So this is the final entry. This will tally our balance sheet. Now let us see one more question based on the SEBI guidelines. Question is, HCL grant 1250 options on 1st April 2005 at rupees 80. When the market price was 200 and the face value is 10 rupees. The vesting period is 3 years and the exercise period is 1 year. Here 450 options were lapsed on 1st May 2007 and the 800 options are exercised on 31st August 2008. Pass necessary general entries to record the above transaction and show the deferred employee compensation account and ESOPs outstanding account, and the state how the account will be shown in the balance sheet. So this is the question. Now the answer part is, when we are coming to the answer part, first of all we have to value the options. So for value of options, here the total number of options into market price minus exercise price. Therefore the value will be 1250 into 200 minus 80. So it will get 1,50,000 and the vesting period is 3 years and the annual amortization is 1,50,000 divided by 3 years, that is 50,000 per annum. And on the grant date, the entry will pass by the entity is deferred employee compensation account data to ESOPs outstanding account. The amount value of options, that is 1,50,000. We have to show the 2 years expenditure because we have in 2007. So on the 31st March 2006 and 31st March 2007, the entry will be employee compensation account data to deferred employee compensation account. So every year we will return off 50,000 from a deferred employee compensation account. So the entry will be employee compensation account data 50,000 to deferred employee compensation account 50,000. This will be repeated in next year also, that is 2007. After this, there is a lapse of 450 options in the third year. So the amount of amortization in first year and second year will be same at the rupees of 50,000. So after that you should transfer to the P&L account the employee compensation account. So the entry will be P&L account data to employee compensation account. And during the third year, on 1st May 2007, there is a lapse of option. Since 450 option lapsed, the liability relating to 450 options shall be cancelled. So how you will cancel and what amount should be deducted? Let us see. Here amount of liability to be cancelled, that is for the value of options for 1,250 there is a 1,50,000. Then what will be the for 450 options, that is 1,50,000 divided by 1250 into 450. So the amount of liability to be cancelled will get 50,000. After this, here the amount is 54,000. So amount of liability to be cancelled is 54,000. So in the last 2 years we have debited expenditure of rupees 1 lakh, that is 50,000 plus 50,000 in respect to the 1,250 options. Since 450 options are lapsed, we have to excess recognize the expenditure in last 2 years. So we have to credit to the P&L account. So the excess expenditure in last 2 years will be there is a 1 lakh expenditure for 1250 options. So what will be the amount for 450 options? That is 1 lakh divided by 1250 into 450. So the amount is 36,000. And the balance in deferred employee compensation account after 2 years is 50,000. That is 1,50,000 we have written off for 2 years, 50,000 and 50,000. So the balance is 50,000. This amount represents the cost yet to be written off to P&L account for 1250 options. For this we have removed the cost relating to 450 options. So the entry will so how we will compute it is means balance in deferred employee compensation account is 50,000. That is 50,000 for 1250 options. So then what will be the amount for 450 options? So it will be 18,000. After that our entry will be ESOPs outstanding account data. So it is a liability, so we have to cancel we have to reduce the 54,000 from ESOPs outstanding account. So we have debited ESOPs outstanding account with 54,000, and already we have booked expenditure excess of 36,000. So now we have to credit to the P&L account. That's why to P&L account 36,000. And the deferred employee compensation account, so this is the excess, so we should credit to the deferred employee compensation account 18,000. So the entry will be ESOPs outstanding account data 54,000 to P&L account to deferred employee compensation account. After the above entry, the balance in deferred employee compensation account will be 32,000. So on 31st March 2008, the employee compensation account debit to deferred employee compensation account 32,000. You should return off in the third year. On 31st August 2008 for the exercise of option. So in the question it is given that 800 options are exercised on 31st August 2008. For this the entry will be bank account data, that is 800 options into 80, 64,000, and ESOPs outstanding account 96,000. To equity share capital 800 into face value 10 rupees, so 8,000, and the securities premium account 800 into 190. So the amount is 1,52,000. With this our balance sheet will be tally. Accounting for ESOPs as per ICAI guidelines. Till now we have seen as per SEBI guidelines. Let us see as per ICAI guidelines. Here in this concept, the deferred revenue expenditure should not be followed. So as we are not following deferred revenue expenditure concept, there will be no entry on grant date. So no entry as passed on the grant date. Now the expense of ESOPs are to be recognized every year, and credit should be given to the ESOPs outstanding account. Employee compensation account data to ESOPs outstanding account. It will be repeated every year, first year, second year, third year, and after that this employee compensation account should be transferred to the P&L account debit side. So P&L account data to employee compensation account. Amount of expense to be recognized and the liability to be credited each year. Further, the formula will be number of options expected to be exercised into intrinsic value or fair value divided by vesting period, and after that you should multiply with number of years completed. After this amount you should be deduct from expenses recognized in earlier years. So the total formula will be number of options expected to be exercised into intrinsic value or fair value divided by vesting period into number of years completed minus expenses recognized in earlier years. Now let us take one example. Here the number of options is 1000 and intrinsic value or fair value is 20 rupees divided by vesting period is 4 years into number of years completed, that is 3 years, minus in earlier years whatever amount you are recognized. Let us take example, first year 5000 and the second year is 3000. So the amount will be 20,000 divided by 4 into 3 minus 8,000. So it will be the amount of 7,000. So this is the formula to recognize the amount of expenses and the liability should be credited every year. Let us see a question. It is based on the ICAI guidelines. A company has its share capital divided into shares of 10 each. On 1st April 2010, it granted 5,000 employee stock option at rupees 50 when the market price was 140. The options were to be exercised between 1st December 2010 to 28th Feb 2011. So the employee exercised their options for 4,800 shares only and the remaining options were lapsed. So you should pass necessary general entry. Here the answer is, here the value of option is 450 minus 50, 90, and the vesting period and exercise period are in the same year. So the entries will be go on like employee compensation account data to ESOPs outstanding account, that is 4,32,000, and it should be the employee compensation account should be written off to the P&L account. So the entry is P&L account data to employee compensation account 4,32,000, and the last bank account data, so 4,800 into 50, so 2,40,000, and the ESOPs outstanding account data 4,32,000. It is the amount of 4,800 into 90 rupees, and to equity share capital account 48,000, to securities premium account 6,24,000. So let us see once again total entry: bank account data, ESOPs account data, to equity share capital account, to securities premium account. So with this question we have completed as per SEBI guidelines and also ICAI guidelines. So we have completed employee stock option scheme in Group 2 accounts. Let us start another new topic in next video. Thank you.